This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Before I get into my guest today, I would like to read a quote. Fantastic quote. This apparently is on the walls in the locker room of the San Antonio Spurs in multiple languages. There are many guys in their team that are speaking more than just English. I love this. This is from Jacob Rees. Quote, "When nothing seems to help, I go back and look at the stone cutter hammering away at his rock, perhaps 100 times without as much as a crack showing in it. Yet at the 101st blow, it will split in two. And I know it was not that blow that did it, but all that had gone before." End quote. What a great way to sum up good trading, good success in life, sticking with it, entrepreneurial energy. You keep pounding, slinging that hammer, swinging it, pounding the rock. Pounding the rock. Speaking of pounding the rock, one quick reminder. If you have not yet gone ahead and put your honest review of this podcast up on iTunes, I would greatly appreciate it. Look, I'm not asking for your firstborn. I could. I'm just asking you to go onto iTunes and write a review. Real simple, covel.com/iTunes. covel.com/iTunes. It helps the process. Jumping into my guest today. An interesting episode, 2 parts. First, Hersh Shefrin, pioneering work in behavioral finance. His main book, Beyond Greed and Fear. Hersh has seen a lot in this subject. And right there were many, the disposition effect, Hersh's work. The second part of my conversation is with Arvid Hoffmann, a colleague of Hersh Shefrin's. Together, they wrote a paper that came out earlier this year called Technical Analysis and Individual Investors. Arvid is a professor of finance at Maastricht University in the Netherlands. Short-term technical analysis, that's their subject. It's not so wise. How are you this morning?
I'm fine. How about you? And where are you?
I'm in Saigon this evening.
How exciting. Oh, yes, this evening.
Yeah, it's about 11 p.m. This is my burden for doing this show when I want to talk to all these interesting people on the West Coast, but I can't rule out California, so I have to stay up late. So
it's is it a burden to be in Saigon?
Is it a burden? No, it's not a burden at all. It's every day is new stimulus, so it's quite fun. It's quite fun. Hey, here's where I want to jump in. So it's pretty easy for me to go online, go to your Wikipedia page, and you are very prominently referred to as a pioneer in behavioral finance. Many of your peers have been on my program. You've got the academic chops, the books, the papers. It's all there. My opening question for you, though, is at what point in time, when in your life, and I want you to define behavioral finance from your perspective as well, too, but when did you know that behavioral finance was your path? You knew this just hit you deep in the gut, and you're like, I love this. When did it happen for you?
Well, behavioral economics came first. So I'll have to answer the question that way. I'd have to say that already in graduate school, I was beginning to question whether the neoclassical approach was really descriptive of how people really behaved. And I was looking for alternatives. So even my dissertation was a little bit out of the ordinary in that respect, but it was still, I'd say, representative of neoclassical ideas, but out on the edge of the network, if you like. And then in my first academic position, when I was at the University of Rochester, my wife was working on eating disorder issues, also as an academic. I was just really struck by how much focus there was on dieting behavior, and how all the advertising that was done sort of promoted food consumption, and at the same time you had all these how-to diet books, and people seemed to be having difficulty. So I became interested in the question of self-control. And then it happened by really serendipity that Richard Thaler at the University of Chicago was also on faculty at Rochester at the same time, and he and I began to talk, and we realized we had this mutual interest in exploring alternative approaches to what drives real decisions about economic behavior. We also had this very strong interest in understanding the basis for self-control and whether there was a non-neoclassical explanation for it. We came to it also, by the way, so Dick came to it through an eating example, just as I did, and we began to work on what today we would call a two-system approach to understanding how people make choices when there are inner conflicts. So Danny Kahneman, in his book Thinking Fast and Slow, that this real terrific bestseller that came out a couple of years ago, describing where Danny describes his life's work. So he talks about the two-system framework as system one being intuition and system two being reason, if you like. And back in the 1970s, really before Dick and I, at least before I had met Kahneman and Tversky, I think Dick might have had some correspondence with them. Dick and I were working on a two-system framework. We called it a two-self framework. So for us, system one was emotion, if you like, and system two was the planning executive function associated with analysis and decision. And we used it to explain how, from a self-control framework, if people really did have a serious self-control challenge, it often happened because their reason, their planning function, wasn't as strong as their underlying emotional forces were. And that was the structure we used to explain why it is that so many regular consumers have difficulty saving as much as they wish they would. Eventually, Dick and I both left Rochester, which was a neoclassical haven, and Dick moved to Cornell and I moved to Santa Clara, where I began work with Mayor Statman, my colleague in the finance department. And Mayor knew a lot about finance, but the behavioral issues were new to him. In my conversations with Mayor, it really became clear that most of the interesting questions in the late 1970s and early 1980s, where we saw potential for the application of behavioral concepts, lay in finance. And I say that it was really at that point on where I began to focus specifically on behavioral finance, and Mayor and I began to work together to put in place what we thought would be a sensible application of psychological concepts to explaining economic behavior, financial behavior in particular. So that was sort of a very long answer to your question, but let me stop here and see whether it addressed the points that you wanted me to address.
Absolutely. I just wanted to kind of get some foundation because it's interesting. You give some backstory that it was coming in through eating, through diet. So I had a feeling there was going to be some inspiration or some tangent that brought you into this world, like all of us that come in some side door, back door, front door. There's not necessarily any rhyme or reason as to how you get into, as you say, serendipity serendipity brought you. But once you're there, you kind of, you wake up, you're like, I'm in the middle of it now. I can't get out. You're stuck. You can't get out.
I don't think I was trying to get out. I think I was trying to get in.
Okay, so so let me give a practical reason, which is from my world, I think it's really interesting. I'd like for you to explain this. So you mentioned Meyer, Statman, the disposition effect. This is something you're well known for your work in. Why don't you define for the audience the disposition effect and how you came to your understanding? Maybe describe the conclusion and what it is exactly.
Well, Mayer and I define the disposition effect as the disposition to sell your winning stocks too early and hold your losing stocks too long. And so it's shorthand. The phrase is shorthand. So we came to it because I think motivated initially because Kahneman and Tversky, in their work Prospect Theory, their seminal work, pointed out that people's attitude towards risk differs by circumstance. When they perceive themselves to be in the domain of gains, they're largely averse to risk. And when they perceive themselves to be in the domain of losses, they tend to seek risk in order to try and mitigate the losses that they're confronting. And so Mayer and I were wondering whether this had application to a well-known phenomenon whereby individual investors, professional investors for that matter as well, but we focused on individuals, tended to try and sell stocks where they were current price was above purchase price really quickly, so quickly that they would forego tax advantages from having their gains go long term. And when they were in the domain of losses, whether instead of selling their losers, realizing their losers, and taking advantage of the opportunity to experience short-term losses, which had favorable tax treatment relative to long-term losses, whether the psychological propensities would lead them to defer realizing and therefore eventually, quite possibly, run the risk that eventually they would wind up with a lower tax consequence as a result, less favorable tax consequence. So we started by looking at the behavior pattern itself. We noted that there had been a terrific set of papers that had just been published by Lees, Llewellyn, and Schlarbaum that documented how individual investors behaved, and lo and behold, this behavior was among the issues that they had identified. So there was empirical evidence that individual investors behaved in this way. And then we set out to put together what we thought was a sensible psychological explanation for why that would happen. So we started with prospect theory as one possible explanation, and we pointed out exactly how that theory would explain the behavior in question. And at the same time, we pointed out that prospect theory in and of itself could not provide a complete explanation for the underlying behavior. And then we shifted to a series of other features. Mental accounting, the mental was one where people think in buckets or silos about their various decisions. Regret was a really important feature. When things go wrong, we tend to engage in Monday morning quarterbacking and wish that we had done something differently, and that creates a lot of pain, especially if we feel that really we've been the decision maker that has resulted in the negative outcome. And so in an effort to not blame ourselves, not to have to accept the full responsibility, we are willing to gamble that somehow things will turn out, that in the case of holding a losing stock, that we really want to take a chance that eventually things will go around, that We don't want to have to admit to making mistakes, so we stick with the bad decision in the hopes that things will turn around, and in the end we can basically sell once the stock gets back up to the original purchase price. And on the flip side, we want to take pride in having bought winners. We want to feel that we're smart, so that when we have a chance to do that, just in case that winning stock reverts and we lose the opportunity to feel good, we go ahead and are willing to pay the price by foregoing tax benefits, and we get out while the going's good. So that provided sort of another way of thinking about the reasons that people might wind up being susceptible to the disposition effect. And then we added self-control, the set of ideas that Thaler and I had worked on some years before. And that really provided us with an overarching perspective, which is that, at some level, our emotions say, hold your losers and sell your winners. And the executive function of your brain might well realize that there are tax disadvantages to doing that. But if emotion and reason are in conflict, typically, unless you have some kind of system in place that will give the edge to reason, emotion wins out. That's why many of us have self-control challenges. So in the end, those were the facets, the psychological facets that we thought were drivers of the disposition effect. And we discovered, I think Mayer was the one to really have found this, a manual written by a stockbroker named Leroy Gross. He was not just a stockbroker, but he was a trainer of stockbrokers. And Leroy Gross had published a book called The Art of Selling Intangibles. And that was basically his textbook for teaching stockbrokers how to be more effective brokers. And he had identified at least the loser part of the disposition effect and had come up with a suggestion for how brokers could help their clients sell losers that was very much consistent with the precepts of behavioral finance, very psychological in nature. And he said that you need to reframe. He didn't use the reframing language that we use in behavioral finance, but he basically said you need to reframe the issue for your clients. He tells his students, I have magic selling words to suggest to you about how to induce your clients to sell their losers. Those magic words are, I suggest you transfer your assets. And the act of transferring your assets is a mental operation that is different from the idea of selling your loser. It sort of avoids the mental circuitry that's associated with how our brains respond when we engage in the act of realizing a loss. And that, he claimed, was a technique that would work, that would help their clients overcome the reluctance to sell losers when he thought it would be detrimental for them to continue to hold. I would say, by the way, that just this past year, a paper came out in quantitative finance that tested this particular prediction and found strong evidence supporting it. So we had a very nice, decades later, test of that particular hypothesis, and it was just nice to see that it panned out so favorably. So again, Michael, another long answer.
No, these are great. I'm curious now. So here's where I want to go. So the idea of cutting short your losses, letting your profits run on, goes back some time. In fact, I'm looking at a webpage right now for a particular hedge fund manager that I know, and he's citing that phrase: short your losses, let your profits run on, to David Ricardo, the political economist from back in the day. We're talking 1700s, early 1800s. And, when I look at some of the early writings, let's say 30s, 40s, there's quite a few traders on Wall Street that would have put out the adage of cut your losses short, let your winners run. I'm curious, and with your work, with your colleagues, did you come across some of these early writings at all? Were you guys coming at it from a completely different vantage and coming to a similar conclusion as to some of the old school traders, so to speak?
Yes. So we came across earlier writers who had addressed the issue. I would say our contribution was to lay out the psychological structure that explains why it happens and suggests ways within the framework that people who are vulnerable to the issue might seek mitigating strategies.
How to deal with it.
Yeah, how to deal with it. So our framework was, once you understand the underlying psychology, then you can understand why these techniques might work. But we were certainly aware of other works. We cited comments by other traders. We didn't go back as far as David Ricardo, although I'll tell you a story about David Ricardo in a second. But we did cite work of people, even outside of economics, who wrote about this particular behavior, particularly on the loss side. There's far less attention to selling winners early. Most of the attention has tended to be on holding your losers too long. But it certainly was a well-known phenomenon that goes back a very long time. And then this is just an aside. So my late mom had moved into a retirement community when she got older, and her best friend Susan's last name happened to be Ricardo. Wouldn't you know it? But she's a descendant of the family. So centuries later, I wind up with this, if you like, this personal connection to David Ricardo. It was sort of an interesting moment when my mom's friend Susan told me something about her family history.
One of the reasons that we're even talking today is that probably back in the early to mid-1990s is I became aware of traders that were systematically employing strategies to do exactly what your disposition effect talks about. And so they were perhaps coming at the idea of how to handle the situation, how to make rules that would force their hands, so to speak, so they would not fall prey to the human foibles, so to speak, but that they would force themselves to take that loss and let those. And I think you make a great point, and I think this applies to much more than, let's say, the markets even. Almost any life success, you really have to, if you start to catch that tiger by the tail and it starts to run, you don't want to get off early, do you?
No, it's compelling. It feels compelling. And so you use the word rules. And so when Mayer and I worked on the disposition effect and we got to the self-control piece, for us, the most important part of that in terms of debiasing behavior sort of took us back to the work I did with Dick. So in the work I did with Dick, one of the things that we really emphasized was the importance of distinguishing between what we called rules and discretion. So rules-based behavior and discretionary behavior. And we argued that for people with really strong self-control challenges, if you have to rely on discretionary behavior, that means having to rely on willpower. And the thing about willpower is that it might work for a short time, but it takes a huge amount of psychic effort. And in the end, it tends not to be able to provide enough strength to deal with what are very powerful emotions to behave in contrary ways. And so people needed to put rules in place. And those rules could be externally enforced. So, for example, if you join, let's say, a 401k plan or a pension plan where money is automatically deducted, and if you're worried about over-consuming, then you don't get a chance because of this automatic deduction feature. Or it could be internally enforced by developing really good habits. And so, people have a part of their brains that mimic what an external enforcer would do. And I think that with the disposition effect, you can use stop loss orders. That will have the effect of external enforcement. Or you could just have a rule that basically says, I'm down by 10% on any security. I'm out no matter what I think, no matter what I feel. And as long as you're able to enforce that habit, and the longer that you have, in fact, been practicing this rule, the less likely you are to breach it, then you'll be able to behave in ways that counter and mitigate the particular vulnerability that you have to the disposition effect. So I'm really glad that you brought up this issue of rules. I think it's absolutely central, not just to the disposition effect, but how to deal specifically with behavioral challenges generally.
Yeah, it's fascinating because, in my world, the way that I've come at things is different. So when I listen to you talk, my imagination and how you're coming at this and you're laying out the scenario of, yes, okay, we know here's the basic mantra: cut short your losses, let your profits run. But then how does one do that? How does one execute that? How does one stick with that, given the context that we are human? And it becomes it's a little bit more than just a pet phrase.
Right. You really need to put in place. You need a clear, actionable plan that tells you, what to do and what not to do. That's what discipline means. Discipline means having a policy in place with clear, bright lines with do's and don'ts.
Let me shift on you a little bit here. So, because we've been kind of in a micro way of thinking for a second, and let me go macro. So if we were to look at the financial crisis 4 or 5 years ago, and some people might argue that it's never gone away as long as the Federal Reserve is involved, but that's not the point of me asking this question. I think the thought that I would like you to expand on, because a lot of people will say, well, certain risks were being taken by banks, or regulators weren't doing their job, or homeowners were trying to buy too many condos with not enough money in the bank. But at the end of the day, you make the case that it was psychological pitfalls. Ultimately, it was our personal psychology, all of the players involved in the process. And it starts there, doesn't it?
Yes. You want me to take it and run with it?
Oh, of course. Do you like my open-ended way of just doing this? I know you've got something to say, so I'm easy.
All right. Human beings are fallible. We are vulnerable to these very persistent, powerful psychological pitfalls. And the question is whether our social system has ways to, in the aggregate, place boundaries that prevent the expression of these pitfalls from taking us too close to the cliff or over the cliff. And the financial crisis suggests that the answer to that question is no. So Kahneman has told us his whole professional life that we shouldn't expect perfection. We shouldn't expect that knowledge itself will provide knowledge of these biases will enable us to avoid them. That the step from recognition to behavioral change is a huge step, not a small step. So the vulnerabilities are going to be there, and they're likely to be there really for as long as we exist as a species. What does that mean for financial stability? So over time, I was familiar with the work of this economist Hyman Minsky, but I wouldn't say that I paid a lot of attention to what he said. He was a macroeconomist, and although I taught macroeconomics, that really wasn't my area of expertise. And he didn't get a lot of press and attention among macroeconomists. And I was familiar with some of the cute phrases that he had coined to convey ideas. One of them was Ponzi finance, for example. But it really wasn't until the crisis hit that I really came to understand the depth of his ideas and to understand that market systems are in fact so vulnerable to financial crises over time that we're doomed to experience them. Our psychological pitfalls are too strong, and the underlying structure of market economies, the whole political economic system, is such that there's really no way to run a market-based economy and avoid them. It's the cost of doing business. The only question is whether we'll be smart enough to keep the crises small, as opposed to really taking us to the abyss, to the edge of the abyss. We were at the edge of the abyss in the 30s, and we were at the edge of the abyss in 2008 and 2009. In the end, and Minsky hearkened back to Keynes. And I have to say that I knew Keynes had talked about behavioral ideas in the 1930s. But it really wasn't until I read Minsky and then went back to my copy of the general theory that Keynes had written in 1936, the same book, physical book that I used to study Keynes as an undergraduate student. I went through that book and saw where I had put in yellow liner and notes and margins and discovered I did not appreciate that Keynes was a super strong behavioral economist. I didn't appreciate how many times Keynes used the word psychology in the general theory. How often he used terms that behaviorists use today, like optimism, confidence, sentiment. They are just very present in the general theory. So this issue of macro stability, crisis, psychology, this was part of the dialogue that existed going back decades. And I think that we just didn't get it. I think that now we're starting to get it. But Minsky, who I think was probably the most underrated macroeconomist, maybe general economist of the 20th century, he really was very clear to tell us that for decades we had mini crises. Now he called, relative to what happened in 2008, you could call them a mini crisis. But we had really very, we were always the S&L crisis of the 1980s, 1974. People actually were talking in 1974 when that recession hit that we might have a repeat of the 30s. We got out of it and it didn't happen. But the 70s was a very scary period. That part of that portion of the middle 70s. And when you read Minsky, although he didn't have the language and vocabulary of behavioral finance really was in its infancy during that period, and he certainly wasn't as well versed in some of the psychological issues as was Keynes. Nevertheless, when you read what Minsky had to say and how he relates behavior to at the individual level and the institutional level to what happens for the economy at large, it's clear that we're simply vulnerable to these pitfalls playing out in a way that brings us to the brink from time to time. And really the question is whether we can learn these lessons well enough and use the insights from behavioral finance to the extent that we can mitigate our vulnerabilities to the point where we don't have to go right to the edge of the cliff. We're going to have instability, but does it have to really threaten the entire world economy? That's really the question. And I don't know. I think that I've learned to temper my tendency towards overconfidence, and I think that I'm not confident we've learned the lessons that over time, we might be doomed to repeat our past mistakes as one generation succeeds another. and the learning. I think we all have to kind of make our own mistakes. As reading about others' mistakes and making our own are two different sets of events. So there's only so much we can learn intellectually, and the rest has to come from experience. So I think that we're a good bet that we will, be seeing significant financial crises down the line.
Let me map something out. So when we started talking today, you were on video, and we had not met before, and you could just tell about somebody. I can tell you're a pretty good-natured guy. I can hear it in your voice. And so as you lay out a scenario, essentially, we're talking about the idea that bubbles and crises, they're inevitable. They don't go away. It's part of the system that we're a part of. But that's not a negative statement. That's not a negative personal statement from you. It's not a negative perspective. And I think what's interesting is that it's just so dang difficult for people to accept the idea of ranges, of bounds, of probabilities. And it's just very difficult for people don't want to live in uncertainty, but uncertainty is the human condition. That is what it's all about. And there's never going to be certainty. I think that's perhaps at the root of all of this. What do you think about that? When you spent a ton of time research and labs and studies, but the human being just doesn't. We want to imagine that there's no such thing as uncertainty, and uncertainty is probably the only certainty that we have.
That's true. Well, the old saying, death and taxes are the only things about which we can be certain, I think is actually apt. That the rest is really a crapshoot. Even Einstein was really uncomfortable with the quantum mechanics framework. Before quantum mechanics, we thought of the components of atoms, electrons and positrons and neutrons. We thought of electrons as little particles that were like little planets circling the nucleus. And the quantum perspective was that, electrons, sometimes they behave like particles, sometimes they behave like waves. And there's even an uncertainty principle that says that you can't be certain about electrons. The Heisenberg uncertainty principle provides us with a definitive, quantitative result about the limits of our knowledge when it comes to certainty about position and momentum for elementary particles. So there is built within us a desire for controllability and for certainty. I think I'm now totally speculating, but I'm guessing that this is a survival technique to help us deal with managing our stress. That if uncertainty breeds stress, then there are hormonal changes within us that gear us towards short-term responses, but that means marshaling resources to have a reaction to a short-term threat. But we don't have the resources to be able to do that 24/7. And so we need some kind of fiction to allow us to allocate our scarce internal resources so that we're not always stressed. And it might be that, the way to do that is to imagine away some of the uncertainty that we confront, so that we don't have to deal with it. That it's the mind's way of helping us prioritize when we need to be on guard and when we need to engage in fight or flight behavior. Humans evolved over millions of years and evolved successfully in their environments. Their environments were much less complex, than the way the world began to look, especially after the Industrial Revolution. But just go back a few thousand years before we learned how to cultivate grain. Civilization is just a few thousand years old. Human beings have been around in our current form for at least 50 to 100,000 years, and before that, somewhat more primitive forms that were just a little bit different than who we are today, but the environments were much simpler. And yet, as a species, we've come to dominate the planet. So evolutionary, we evolved with a degree of imperfection that was good enough relative to the environment, and that means the physical landscape. It means the other species against whom we competed for resources, but that doesn't make us perfect. I think that we're highly imperfect, and now we're facing up to the degree to which we are imperfect as we have the knowledge to do so. I like to say that because we've come to expect perfection from ourselves, which I think is hubris as a species. But I think we're a little hard on ourselves in that respect. I think our brains evolved the way that Microsoft built software. You'd start with something, and then you'd add features rather than go back and redesigning every time. And those new features would always be built on an existing platform. And so there would always be workarounds and little bugs and therefore patches. And Microsoft was always sending out new patches to deal with new upgrades to its software, and that's the way our brains developed. Our brains developed by putting this very developed cortical structure on top of a primitive limbic system that we share. The limbic system we share with lower forms of life. But it's not perfect. It was always building in order to adapt to changes in the environment, not to be perfect. Nobody ever went back and redesigned our brains from ground zero to be perfect. So by nature we're imperfect, and evolution evolves by mutation. So when the environment changes, nature's designed us so that there's some mutation around that will thrive in a new environment. When the rest of what used to thrive finds that it's no longer able to deal with the change and disappears. And that's a patchwork type of structure as opposed to designed to be perfect type of structure. And so I think this issue of uncertainty and risk, and the fact that we tend to try and pretend that it's not there because we hope, almost by wishful thinking, that the world should be a place where risk and uncertainty are absent or small, is just one particular side effect of the way we've evolved.
As we're talking about imperfection and uncertainty, and we talk about the idea of rules, and I find that one of the best ways to deal with imperfection and uncertainty is to travel. I find when you travel, you realize that uncertainty is the norm and imperfection is the norm. It's just not going to work the way you expect. And especially when you do the international traveling, regardless of where your home base is, anybody's home base. And that I find that in my own being, I become more robust. I actually enjoy the imperfection. I enjoy the uncertainty, and you find the smiles and the fun and the laughter from something zany, crazy that you don't expect. And it calms you. It becomes, you're kind of like, oh yeah, I know I expect something zany to happen that I can't really predict. And I'm okay with that. It's fun.
So I think that probably means that you find yourself ceding control.
Ceding it?
Yes. So we have people vary on the dimension of how strong they need to feel they have control. When you travel and you leave the familiar and move into the unfamiliar. So when you're in a situation where you feel familiar, that's a situation in which it's more natural to feel that you have control, and therefore to feel that your risk and uncertainty should be low. But when you travel to a new culture, a different culture, you have to, just to be realistic, you have to confront the fact that you have a lot less control in a foreign environment, in a foreign culture, than in your own culture. And that opens you, as a result, to the recognition that you should expect to experience more uncertainty and therefore more, quote, surprises. And in your case, I think what's healthy is you've learned to embrace the surprises as positive, to take pleasure in them. So those surprises will, generate dopamine in your brain when they happen.
Yeah, I'm high all the time, Hersh.
Keep it up. It's a gift.
It's true, though. It is. It's an absolute nice feeling. I know everybody can't do it and this and that, but ultimately at some point in time of our life, I think everyone pushing through the boundaries and things that we think are walls. There's something nice on the other side that you have to believe me that it's there.
Sounds good.
Listen, hey, where's the best place that people can go to check you out, check out your works, your books? Where can people go?
I think probably just my website at Santa Clara.
Okay. Hey, listen, Hersh, hopefully we can talk again in the months and years to come. And I appreciate you coming on today and educating my audience and me.
Have a nice evening in Saigon. Take care.
Take care. See you, Hersh. Much fun speaking with Hersh. Now, on to his colleague, Arvid. We talk specifically about the paper that I mentioned in the introduction. You have a paper out. Technical Analysis and Individual Investors came out earlier this year. What motivated that? And why don't you not only what motivated, but why don't you explain big picture what were the results?
So you mean motivate in terms of why we did this study?
Yeah, why did you do it? I mean, it got a lot of, I caught it because of the press. I saw some press. I saw people perhaps using the headlines for other purposes, and it just intrigued me. So I read it and wanted to chat with you.
Okay, sure. Well, basically what we did was in 2006, we had access to a large-scale survey by an online brokerage firm in the Netherlands. And part of the survey measured the investors' objectives that they have with their accounts, as well as the strategies that they follow when trading on their accounts. And at the same time, we could get access to these investors' trading records. And then we dove into, basically we were diving into thinking, what can we do with this? How are investor objectives and strategies impacting their portfolios in terms of behavior, in terms of performance? And while working on that, we came to the conclusion that actually there has been very little research about how technical analysis impacts individual investors' behavior and performance. So we decided to focus on that eventually. And our main findings are that investors that in our survey report to use technical analysis to come to their investment decisions trade more than investors that do not report this strategy. They also are more prone to actually have speculation on short-term stock market developments as their objective, hold more concentrated portfolios, have risk exposures with a higher ratio of non-systematic risk to total risk, trade more options, and overall also earn lower returns. So it seems that technical analysis is a channel for individual investors through which they can express their overconfidence and excessive optimism.
Let me dig into some of the terminology and how you use it and how you define it, because I think we can both agree from the outset technical analysis can have wide meanings to different audiences. So how would you define technical analysis?
Well, it's a good point, because we do not know exactly how the investors that report to our survey define technical analysis. The broker defines technical analysis, so the questions that we posted to the clients, they post technical analysis as, let me take a look, to say, with technical analysis, one observes the past and tries to recognize patterns in a historical graph. Based on this, one takes a stance on the future stock price development of a company. So in the blink of an eye, one can see whether a fund or a stock is worth buying according to its technical analysis, showing a fund's trends, support levels, resistance levels, etc. So that's the way that these clients were informed what technical analysis would be. However, of course, how they themselves interpret technical analysis and what it really means for them, we don't know, right? We just know that they say, I use some form of technical analysis in my trading, and that is an important strategy for them.
Now, most of these traders that made up the study, their data, these were extremely short-term traders using options.
So many of the traders use options. So this is typical for the Netherlands, that many investors use both options and equity with hold concentrated portfolios. And it's true that in line with other studies on individual investor behavior, for example, by Barber and Dean or Dorn and Sengmuller, which use these online discount brokerage clients, that they are not in for the long term really, but are trading quite frequently and holding their positions for a short period of time.
Let me open this up to maybe some broader connections, because I saw, like I said, I saw some of the press. I saw an FT article. I saw a Business Insider article, and the Business Insider article pointed out, okay, you have fundamental analysis, you have technical analysis, and technical analysis attempts to predict. And the FT article, which kind of also caught my eye, connected your work to larger areas that somebody could say are in the sphere of technical analysis, for example, like managed futures. And so I kind of want to, we can open this discussion up, but I'm curious, your work and what you were getting at, it sounds like to me you were keeping it in a fairly narrow focus.
That's true. So we're mostly interested in how technical analysis can basically be the fuel that helps to ignite investors' overconfidence and excessive optimism, seeing how just reporting to use technical analysis, what's the impact on investors' behavior and performance. So we're not really looking at these broader patterns in terms of futures trading, etc. And I think one important thing also to mention is that our conclusion is not that technical analysis is a bad strategy or that it cannot work. It's just that for the investors in our sample, reporting to use technical analysis goes together with focus on getting short-term investment returns, trading a lot, and under-diversifying. That does not mean that in general the technical trading rules themselves are bad, right?
Yeah, it was interesting because I guess, I go back years and I think about some of the early writings and research that I put together. And I thought one of the early confusions with technical analysis, and to this day, I don't think it's stopped, because if I look at the author of the FT piece, bringing managed futures in, and the primary strategy in managed futures is trend following, which is a very longer term technical type strategy, which really doesn't involve predictions and short-term pattern recognition or anything of the like. So I'm curious, when you were doing your work, did you think about that, how the interpretations might be? Because clearly some of the writers out there took your work and the conclusions you drew and attempted to apply it to other areas. And if you want to comment and talk about those other areas, I mean, I'm curious your view too. We don't have to share the same view, but I'm curious to how you view this.
Well, basically we do see that investors who use technical analysis are also less inclined to bet on reversals. So they have a higher loading on the momentum factor in this 4-factor model explaining returns, Scarhart model. So it seems that there is this trend following component in their behavior, but obviously this may be a relatively short-term trend following that they are doing.
Mm-hmm. I guess, okay, so I'm trying to take a step back. And your piece was not attempting to, because look, I would enjoy the conversation and we can kind of open it up, but your piece wasn't attempting to kind of go to the larger issue of, for example, the success of Winton Capital or TransTrend in the Netherlands or Capital Fund Management in France, which are primarily professional, longer term, reactive technical analysis type traders, but they're not doing the types of strategies that were part of the data set that you were working with.
No, so basically that's correct. We didn't really look at We were not aiming to look at these phenomena that are described. And of course, in the paper, we're still looking at a relatively high level of aggregation, in the sense that we look at what are their returns, how often do they trade, how diversified are they, but we're not looking into their individual positions, seeing what kind of strategy may they actually try to follow, or what kind of technical analysis indicators could they be using, considering their trading patterns. So the honest answer is that we were not really interested in that, or at least not aiming to look at that. And the popular press picked up our article and basically made it a much broader issue about technical analysis. Is this a good strategy or a bad strategy, which was not our intention.
Yeah, because I agree with the idea that people using, I think not only does your work show this, but I just think looking at cross sections over the last decade or so in my own world, I think the idea that people are using short-term pattern recognition to predict market moves, there's just not much evidence for it. And here you've gone ahead and found a data set that shows really there is not much evidence for it.
No, right. Yeah.
Your conclusions. I'm curious about your conclusions, because you map out this scenario where you say, okay, and wisely, like I said, I agree wisely, the idea of people trying to use technical analysis on a short-term basis to predict market moves as a trading strategy, I would like to throw cold water all over that. It just doesn't make much sense. And your data set shows that. But, I'm curious about your conclusions. And there was two big conclusions that I saw. Invest as if the market was efficient and restrict your attempts to beat the market. Maybe that first one, and I'll let you go to the second one too, but invest as if the market was efficient. What did you really mean by that?
Basically, what we mean with that is that investors should not individual investors should not try to identify undervalued stocks, or then really excessively trade, looking at arbitrage opportunities, in the sense, because most likely for the average individual investor will not be able to really identify such opportunities, and probably will overtrade and accumulate too many transaction costs while looking for such opportunities. So the whole idea basically was that for the average investor, it will probably be much wiser to just hold a low-cost index fund and rebalance now and then, but not actively trade. So the whole data set, of course, shows investors that are trading very, very actively, making concentrated bets on specific stocks, taking unsystematic risk. But basically, it doesn't lead to better returns for them. So they're not able to identify with their concentrated portfolios those stocks that are indeed undervalued or that can give them excess returns. So in the end, it may be better for them to just accept that there's no low-hanging fruit or free lunches, and just stay with the index.
Yeah, I think it's a worthy conclusion for many out there. For those people that want to get rich and dream of easy money and sit in front of a screen all day long, day trading, I just think the evidence isn't there that this is a successful way to go. And we haven't even got into the idea of the biases and the emotional aspects that go along with this style of trading, this constant turnover and trade volume to try and beat the market on a short-term basis is just really, really tough. And there might be some professional arbitrageurs out there that have massive staff and massive data bank of servers and the like and all that kind of stuff, and they can effectively do it. But most people are not JP Morgan. In my world, I think there's quite a bit of evidence that on the longer-term side, a systematic, reactive, technical type strategy employed by some of the larger funds can be effective. Now, you still have to have the discipline and all that kind of fun stuff, but it can be effective. There's some evidence for that. There's been quite a few papers in that space too, academic papers. But I think there's like a free ride. People get a free ride on, like, when they come on TV and they come on CNBC and some guy comes on with a chart and he starts saying there's some kind of pattern that he's seeing, and this is going to happen tomorrow, and 2 weeks later it doesn't happen, and there's never any there, and there's no evidence, there's nothing empirical. So I think it's very useful to get people thinking about this short-term technical analysis and pattern recognition stuff. Like, hey, if you're going to try and make the case for it, well, where's the evidence?
Well, exactly. I mean, there is some evidence in general on the value of technical trading rules, and that in some periods in some countries they can generate excess returns, but on average, the profitability of those rules have been really diminished recently, and especially for individual investors who face higher transaction costs, relatively speaking, it just makes no sense. My point is that as long as individuals are aware of the costs of this day trading, the costs of investing as if it is a hobby, so just realizing the costs they're incurring and the risk that they have by doing so, then I think it's not really a problem. If they realize, okay, this is a hobby, I'm willing to pay for it in terms of my returns, then that's fine. But I would say that most individuals are not aware of the risk that they are incurring and about the costs that they have in terms of speculating on short-term trends. So that's really the problem, that you can see investing as entertainment as long as you realize that it's a very costly hobby.
Yeah, I think it's similar thinking to those older folks that want to sit in the casinos and play slots all day long. If they truly understand what they're doing, and they have a budget and they don't go past that budget and they stay solvent, go for it if that's your form of entertainment. But I don't think most people do that. It becomes a problem for most people. Yeah,
and most individual investors probably do think they can beat the market and are expecting to get some positive returns of all their trading activity. So indeed, it's better for them to just stay passive, which is boring, but maybe much better in the long run.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.